Building an investment plan when your wealth came from your business, it's different from many other types of retirees. And there's three primary considerations that we want to take into effect when you are that business owner who sold the business and now your investment plan needs to be built. The first is what got you here won't get you to where you need to be. And so what we mean specifically around that is the old saying is you want to concentrate to get rich and then diversify to stay rich. A lot of business owners that we work with, they took a lot of risk in building that business out of nothing, and working the late nights, in doing the sweat equity, in making the sales calls, and getting things across the finish line, and really putting an extraordinary effort to build that business. But that concentration risk that you took all that time with the business and growing your net worth in the business, you won't be rewarded for that in the market. So if you took everything you owned with the business, sold it, and you bought Tesla, or you bought IBM, or you bought any company you want to pick up, GE, no matter what that company is you buy, you put your entire net worth in it, you don't get the benefit of that concentration risk. So we have to be diversified. And that leads us to our second thing. When we're building that specific investment plan, what we love to do with the combination of stocks and bonds, real estate, alternatives, what we love to do is to take a 6-month breather before we make any major investment decisions. And the reason why that is when you're going through that business sale, it is a job in itself of getting all of the due diligence questions completed, of all the files, of the tax returns, of inventory, personnel, everything you can think of under the sun. It's a massive overhaul. And a lot of people feel when they get to that finish line, they're essentially kind of spent, right? Plowed your entire lifetime into building this business. If nothing else, the past number of years, especially the past number of months in building out that business. Now that you've got across that finish line to make investment decisions, you actually have a bit of a decision fatigue. So what we love to do is we actually say, all right, look, we know we have a couple of quick wins here. Maybe we've always wanted to do 2 or 3 different types of investments. Let's go ahead and do those. Let's take a pause for at least 3 to 6 months, where we put that money in cash-like investments. We earn a nice yield on it, and it builds us the time to kind of get that mental clarity as to, okay, within the investment framework, within stocks and bonds, real estate and alternatives, how do we want to allocate? Now, we have a recommended allocation for our clients, but we're going to tilt it because personal finance is more personal than is finance. So making those decisions and not rushing and putting all the money to work right away, that is a very common mistake that we see. Let's not make that mistake. The third and final consideration that is specific to business owners when your net worth has come from the sale of the business is how you use alternatives within your financial plan and within your investment plan. So what we mean by that is, as a business owner, many times you have off-market investment opportunities. Knowing you have access to those, we need to alter your investment plan and in fact your financial plan to meet those off-market opportunities. So what I mean by that is maybe we hold a little bit of extra cash because we know that a friend of yours is going to start up a business, or you've looked at looking at a different line of business and that money would come from this cash source. So even though we're a little bit heavier on cash, it's because we're planning on using it in the future with small businesses. Then what you take is, all right, so if I have my cash and I'm with my taxable account and being a little bit less risky, maybe you take additional risk in your IRAs and your 401ks so that your overall blend of the investment plan has the right allocation of, risky assets and non-risky assets. Again, when you're coming back as a business owner and you just sold your business, you need to recognize that you do have a bias. That first bias is, look, I think I can do this. I can take that concentration risk and I can grow my net worth. What got me here is not going to get me to where I need to be. I'm going to concentrate to get rich, and I'm going to diversify to stay rich. That's the first thing. Second thing is recognizing that your combination of cash, bonds, stocks, and real estate investments, taking a breather after the sale of the business, because you do have decision fatigue with everything you've had to take into consideration with the sale of the business. And then that third and final thing is the use of alternatives, recognizing that holding back a little bit of extra cash, knowing that you ultimately deploy it into a small business or a real estate opportunity, that's ultimately where we're going with that money. So holding a little bit of cash as a business owner and knowing that you're seeing off-market deals, it's a really smart thing to do. Thank you.